Example 3, determining the tax base of a liability. The following information pertains to the hypothetical company Antigua Sports for the fiscal year end. The treatment of items for accounting and tax purpose is based on fictitious accounting and tax standards and is not specific to a particular jurisdiction. Calculate the tax base and the carrying amount for each item. Antigua Sports made donation of 100,000 in the current fiscal year. The donations were expensed for financial reporting purposes but are not tax deductible based on applicable tax legislation. So this would be a permanent difference because it is the donation were expensed for financial reporting purposes, so it is tax deductible as far as accounting purpose is concerned, but for tax purposes it is not tax deductible. So donation carrying amount would be 0 because all the 100,000 would be used to reduce your taxes, but it is not for the tax base, though the donation would again be, the tax base for the donation would again be 0 because that money is gone. So you have reduced your income statement with that money, but again it is not be used to reduce your taxes, and hence it is a permanent difference. The temporary difference would be 0. Interest received in advance. Antigua Sports received in advance interest of 300,000. The interest is taxed because tax authorities recognize the interest to accrue to the company on the date of receipt. Now if you are receiving this 300,000 today, it is interest received in advance, so it will be taxed for tax purposes, but it will only be taxed when it is earned for the accounting books or for accounting purpose. Now for accounting purpose though, including the financial period in which it is deemed to have been earned, so it is not earned at this point, it will earn in the future, hence it will be taxed in the future. But because for tax purposes, for tax base, if you have received it now, it will be taxed. So carrying amount, interest received in advance would be 300,000 because it is not being used now to give taxes. So on 300,000 the tax is not given for accounting purpose, but for tax purpose this 300,000 is taxed, hence the tax base is 0 and is a temporary difference of 300,000. Rent received in advance, same case would apply. Antigua recognized 10 million for rent received in advance for a lessee for an unused warehouse building. Rent received in advance is deferred for accounting purpose but taxed on cash basis. So if you have received your rent in advance, it will be taxed, but for accounting purpose it will not be taxed. Hence for the carrying amount for rent received would again be 10 million because it is not taxed, but the whole 10 million is being taxed for tax purposes. So the tax base would be 0 and again it would be a temporary difference of 10 million. Loan, you have taken a loan for 550,000. Now taking out a loan has nothing to do with tax. Antigua Sports secured a long-term loan for 550,000 in the current fiscal year. The interest is charged at 13.5% per annum and is payable at the end of each fiscal year. Now repayment of the loan has no tax implication. So again the carrying amount and the tax base would remain same. It has no tax implication. Though the interest paid will reduce your taxes, and again it will be for both carrying amount and for the tax base, hence it is 0 at both cases, and again the temporary difference is 0 over here. Example 4, taxable and deductible temporary differences. Example 2 and 3 illustrated how to calculate tax base of assets and liabilities respectively based on the information provided in example 2 and 3 indicate whether the difference in the tax base and carrying amount of the asset and liabilities are temporary or permanent difference, and whether a deferred tax asset or liability will be recognized based on the difference identified. Now deferred tax liability or deferred tax asset is generated when the difference is temporary, and if in the case of assets, if your carrying amount is more than your tax base, deferred tax liability is generated. So dividend received, it is again there is no temporary difference, so neither deferred tax asset nor deferred tax liability would be generated. For development cost, we see the carrying amount is more than tax base, hence deferred tax liability is generated. Research cost, carrying amount is less than deferred tax base, hence your deferred tax asset would be generated. Account receivable, your carrying amount is more than tax base, hence again deferred tax liability would be generated. For example 3, in the case of a liability, if carrying amount is more than tax base, deferred tax asset is generated. Donation, again the temporary difference is 0. Over here, carrying amount for interest received, carrying amount is more than tax base, hence deferred tax asset is generated. In rent received as well, your carrying amount is more than tax base, hence again deferred tax asset is generated. And again, in loan and interest paid, the temporary difference is 0, so neither deferred tax asset nor deferred tax liability would be generated. Taxes charged directly to equity. The following information pertains to Khalij Company. A building owned by Khalij Company was originally purchased for 1 million in January 2001. Let's suppose, for accounting purposes, buildings are depreciated at 5% a year on a straight line basis. Depreciation for tax purpose is 10% per year on a straight line basis. So for accounting purpose, it's 5%. 5% of 1 million is 50,000. So the depreciation is 50,000, and for tax base, the depreciation is 100,000 because it is 10%. And again, because depreciation is higher in tax base, the tax base would be lower. And in the case of asset, we know that if carrying amount is more than your tax base, deferred tax liability would be generated. And over here, because of low depreciation, carrying amount would be higher than tax base. The building is revalued at 1.2 million. It is estimated that the remaining useful life of the building from the date of revaluation is 20 years. Now the important part is, for tax purposes, the revaluation of the building is not recognized. Very important point. Based on the information provided, the following illustrates the difference in treatment of the building for accounting and tax purposes. Now, initially the depreciation is 50,000 for carrying in accounting books, and for tax books it's 100,000. This is your carrying amount. This is your tax base, again 50,000. Carrying amount is 900,000. 800,000 is your tax base. Now, revaluation is allowed in accounting books, so we add 300,000. So the value of the asset goes up to 1.2 million because it was revalued at 1.2 million in the end of 2003. So there is an increase of 300,000. It went from 900,000 to 1.2 million. And now the depreciation would be 60,000 because 5% of 1.2 million is 60,000, and this is your new carrying amount. These are your depreciation. And again, 60,000 is coming. How? 1.2 million into 5% is 60,000. Now over here, carrying amount is more than your tax base in all three scenarios. So your deferred tax liability would be generated. So deferred tax liability is carrying amount minus tax base multiplied by tax rate. Tax rate is 40%. So 50,000 into 0.4 is 20,000. So this is your deferred tax liability. How we get 50,000? 950,000 minus 900,000 is 50,000. 900,000 minus 800,000 is 100,000. And your tax rate is 40%. So your deferred tax liability would be 40,000. Now your carrying amount is 1.14 million. So 1.14 million minus 700,000. The difference between 1.14 million and 700,000 is 440,000. And your deferred tax liability would be 176,000. Now we need to understand that this number that we are getting is actually wrong. This is not the correct deferred tax liability. Why? Because the 300,000 revaluation, the increased in the value of the asset that was of 300,000 goes directly to equity, and it is not for taxing books, so it's a permanent difference. So this, we cannot use this 300,000 because it is not allowed for the taxing books. So if we do not include this 300,000, we need to reduce this factor 300,000 into 0.4, that is your 120,000. So out of this 176,000 we need to deduct 120,000, and if we deduct 120,000 we get 56,000. This actually would be your deferred tax liability. Or in the other case we can also do it, there is another way to do this. If we subtract 300,000 from 1.14 million, what do we get? So if we subtract 300,000 from 1.14 million, we get 840,000. So 840,000 minus 700,000 into 0.4 will going to give us 56,000. Now your actual deferred tax liability would be 56,000, not 176,000. So your deferred tax liability would be $56,000. And the change in the deferred tax liability from the last year would be 16,000, because it was 40,000 and from 40,000 it is going to 56,000, so the change is $16,000.